70% returns on the same day is possible with 0-day expiration options, and it comes with some surprising benefits when compared to longer dated options. So let's get right into the good stuff and show you how I trade short-dated 0-day expiration options. Now, one of the bigger reasons that I like to trade 0-day and short-term options for swing trading, especially on SPX, is that there is far less capital required than for longer-dated options. You also know the outcome often the very same day if for trading 0-day expiration, because the options quite literally expire that day, or in a few short days if you're swing trading. So, for example, for swing trading, I like to use no more than 7 days to expiration. I will know on or ideally prior to expiration if I'm in a winning position so that I can manage it successfully. And the bottom line is that if you are successful, your profits are locked in that very same day, and you don't have to hold and hope or YOLO or diamond hands or any other nonsense like that. So you quite literally have zero overnight risk. And if you're trading SPX like me and my students do, you'll also have zero assignment risk. If you're trading overnight, you don't have that worry of, will I be issued shares if you have an in-the-money option. Now then, with that said, I'm frequently asked to share my best 0-day expiration option strategy for short-term trading. So let's take a look at it. I'm going to show you my top strategy right now. Just before we do that, if you are new to options and need a strategy that simply works, you can access my book, which outlines all of the strategies that I like to trade with SPX options. And if you're ready for a mentor to show you the way so that you can get real results now in the fastest and smartest possible way, as well as access to the software and tools that I use, then click the links in the description below. So back to it, 70% in 1 day or 0-day is possible with short-dated options. My setup for this is 30-minute charts with Bollinger Bands set to a 50-period setting. And I also use something called pulse bars, which I'll explain on a separate video. I do explain in detail in my book as well. If my system is bullish, which if you're familiar with Bollinger Bands, one of the ways that I trade is with a breakout. You can just see there on the chart, price is above the upper Bollinger Band. The current price is marked. And the way that a credit spread is set up, so basically I'm bullish is the bottom line here. We've got a Bollinger Band breakout, and I'm looking to sell a put spread. So I'm going to sell an option that is near the current price, and then buy an option at the same time that is further away from the current price. Package that together and you call it a credit spread. And as the name suggests, you receive a credit for placing that trade, and that gets deposited straight into your account. Now, on the option chain, it looks a little like this. And obviously, your broker may be a little bit different to the one that I've got here. But most brokers allow you to right-click on the option chain. You can mouse over sell and mouse over vertical, and it will set the trade order up for you. And again, you can see there visually, I'm on the put side. I'm selling near the current price and buying further away from the current price. Let's look at the numbers. This results in a credit, as we've already established. So the current price is $52.46.68. So I'm going to sell typically the nearest strike below the current price. That's my personal preference. I am a more aggressive trader, and I'm going to buy further away from the current price at $52.40. The difference between the two strikes is $5. That's important in just a moment. For that package, I will receive a net credit of $2.15 per share. So normally, an option contract represents 100 shares, so I need to times that by 100, and I know that I'll receive $215 per spread. Now, the risk in this is the size of the spread minus the credit received. That means there's $2.85 per share, or $285 of risk at play on this particular trade. When you place this trade, you will result in positive cash flow coming into your account, and you can start to see why this is called a credit spread, as well as sometimes called income trading, because you're receiving an income from your trading quite literally straight away. Whenever you sell something, you receive an income. Now, then, another point to consider when trading SPX, as I mentioned very briefly earlier, I like to be a little bit more aggressive in my trading because there is zero assignment risk. I can actually sell an in-the-money option so close to expiration because there's no assignment risk, and you've got this European style option as opposed to a US option. And that's a conversation for a different day, but ultimately, it means that I have no assignment risk. Just let that sink in for a moment. Now, because I can sell near the current price with no assignment risk or fear of being assigned shares that I don't want, I can sell that spread for more premium and collect more credit up front because of that. And again, I do this because I have quite literally an excellent timing mechanism as a part of my overall trading system. And at the end of the option's life, so later today, for example, if you're trading 0-day expiration, you will know if you're making money or not, as the case may be. Or if you're trading 3-day expirations or 5-day expirations, I'm sure you get the point by now. Again, when I'm swing trading, on the screen, you've got an example of a swing trade. One of the systems basically takes advantage of the ebbs and flows back and forth of the markets, and you can profit with a nice simple timing mechanism using Bollinger Bands and pulse bars to profit from those swings. Now, the great thing is with the credit spread is I don't need the directional move to profit from a credit spread. If I do, I'll get paid a little bit quicker. But if I don't, that's okay as well. I typically let my 0-day expiration trades expire for 100% return. I rarely close them early, which means that you can day trade without being subject to the pattern day trader rule as well. Also under conversation for another day. Now, for the swing trades, I do have a profit objective, as you can see on the screen there. Visually, you can see we go from the low Bollinger to the upper Bollinger on a very regular basis, you'll see. So it's not always practical to let it go to expiration. I usually have that target of the opposite Bollinger Band in mind, and the credit spread will usually see around about a 60% credit on average. Again, sometimes more, sometimes less, but usually it averages out around 60% of the credit received in anywhere from 1 to 3 days is how that usually works for me. So that's it. That is my credit spread income system. Myself and my students get great results from this. So again, if you are new to options and need a strategy that simply works, you can access my book, which outlines this strategy in a lot more detail, as well as what the pulse bars are as a timing mechanism. And if you need a mentor to show you the way, you'll also get access to my proprietary software tools that make this even easier than ever before, so that you can profit from the markets in the fastest and smartest possible way. And if you'd like to know more information about either of those two things, click the link in the description below.